Home Depot stock has risen over 33% in the past year. And today we're talking about a clear market leader with a wide moat, which you could consider as the perfect boring stock, as it has a low competition and low sector innovation, but it has solid fundamentals and extremely high efficiency ratios. So let's jump into Home Depot, an improvement retailer. In their annual report, Home Depot describes their operations as offering customers a wide assortment of building materials, home improvement products, and facilities maintenance and repair products. They have two main customer segments, the first one the DIY segment, and the first one DIFM customer segment. Basically, the DIY is when people want to do the repairs and all the work themselves, and DIFM is when people prefer to hire someone else to do the work for them. In other words, they sell to individual customers, like individual people, and they sell to businesses which focus on home repair services. They have successfully created a seamless connection between the digital and the physical sales channel, and their strategy going forward is 3 Ys. First one, to provide the best customer experience in home improvement. Second one, to extend their position as the low-cost provider in home improvement. And third one, to be the most efficient investor of capital in home improvement. And so far, they have been doing great at achieving those objectives. They have a return on capital employed of 31%, which is insane and something extremely rare amongst retailers. And they have a great interest cover of 48 times. This basically means that they have no liability risk in the short term, as they can pay off their interest payments 48 times over with their current net income, or with their current free cash flow. They have a cash conversion of 61%, which is a bit lower than the one we usually want to look at. We generally want a cash conversion of around 85% or higher, but this is good because it means that they have room to run. Then their profit margin is solid of a 32%. This, we would like it to have it a bit higher, but it's a retailer, so it's generally and intrinsically going to have low margins, and their operating margin is right where we want it, 15%. We want it to be higher, but 15% for such a large-scale retailer is extremely impressive. This is the one thing that does worry me a bit. Their revenues, gross profit, and net income have stayed fairly stable for the past 2 years, and with no clear signs of growth. And the fact is that this company is already so big that they're having a very hard time at growing their revenues, because the majority of their customer segment is already tapped and is already buying their products. But their efficiency ratios are as high as ever. They're extremely consistent, with the return on invested capital sitting at 24%. I would ignore the return on equity of 1,300% because it's very biased by the fact that they are not a company that has a lot of equity, but they finance their operations instead through liability. But this company has actually very low liability risk. They have an extremely solid balance sheet, meaning that they can pay their current liabilities only with their current assets and their long-term liabilities with their long-term assets, so they're safe in that stance. Things that worry me is that, first of all, they don't have a cash flow consistency. Their cash flows are not consistent. They're not predictable entirely. And I think this company is fairly cyclical, since customers and people will buy home improvement materials when they're having a good time. They're having more disposable income than they were having before, so they can spend it on these type of things. Then they do offer dividend, a very consistent dividend, and they offer share buybacks, which is good to see. And they have extremely good pricing power over their suppliers, not over their customers, because they are focusing on being a low price retailer, but on their providers, they are able to squeeze them to get the best prices and enhance their margins and keep that 15% net margin that we have seen previously. Some more two things that I don't like. The first one is the organic free cash flow growth. It is very hard to grow organically the free cash flow when your revenues are not growing organically. As we saw in the graph, they do not have an organic revenue growth. It's not growing year by year. And 2024, actually, the revenue contracted by 4 or 5%. This to me is a bit of a warning sign, because it shows some uncertainty on what the future of the company will be, because it's such a big company, as we mentioned before, and it's very hard to actually grow the revenues. And if you don't grow the revenues, there's only one way to grow free cash flow organically, which is just reduce headcount and reduce all type of expenses. However, for a company like Home Depot, I think that's going to be a lot harder than for leaner, more innovative, and more platform-based companies like Meta or Google. But the final one, which I believe is the most important box in this slide, is the fact that they have an existing moat and a competitive advantage. In my experience, I don't live in the US, but if I ever want to think about home repairman services or buying building materials for my house, the first company that shoots into my head is Home Depot. Their dividend is a thing of beauty, is extremely consistent. They have a dividend yield right now of 2.28%, which is very, very good. And they have a payout ratio of 54%. This means that out of their cash flows or out of their net income, they're only expending around 54% of them to pay their dividend, meaning that if they have a bad year with their net income or with their free cash flow, they still have a lot of room to cover the dividends that they're actually paying right now. And it has been consistently increasing quarter by quarter for the longest time I can remember. One good thing as well, as you can see, the amount paid is growing at a slower rate than the dividend per share. What does this indicate? Well, this indicates that they are also conducting share buyback plans, which is very good as you get the double effect on your return on investment. It's such a big company, such an established brand, that it's very hard to appeal to new audiences and very hard to get those audiences to spend more on your goods. However, I would divide their growth avenues into two ones. The first one would be new location development. I believe they're currently only open in Canada, the US, and Mexico. So maybe moving into other segments or doing pilot tests like Costco is doing, moving into China, moving into Europe, would make their revenues shoot up. And if they work, this company would go back to having a solid growth plan. The other one would be just to enhance their existing locations by offering more differentiated products, conducting a bit of upselling. But we will have to see what the CEO and the board have in store for us with the growth potential of this beautiful company. Further valuation, I think this company will always trade at a bit of a premium. It's such a historical company, such a established brand, such a good company that they will always be at a kind of a premium. Their PE ratio, however, is at a 24, and a PE ratio of 24 is not generally considered to be a high PE ratio. However, when you're considering that this company has a tough time growing their earnings, it does shine light on why this company has a 24 PE ratio rather than having a lower one like 15, which is usually the one that goes for low growth companies. Well, this is because it's a high quality company which is yielding very, very high amounts of free cash flows, paying a very, very solid dividend, and it's been here for the longest time ever. On the other hand, their free cash flow yield is 4.2%, which is a lot higher than the long-term inflation rate of 3%. So this would indicate that the stock could be attractively priced as long as it manages to grow their earnings. Because, as Terry Smith says, a company is attractively valued when its free cash flow yield is higher than the long-term inflation rate, as long as the company is able to grow their earnings. And now for the risk and possible challenges, I identified the main risks as performance and market, but we will get there in a sec. Competitor, I believe they have a very low risk. It says 40% and there's only 3 squares ticked off, but I don't mind 30 to 40%. This is due to the fact that this company is already the king of home improvement building materials. As I said, they have such an established brand and such a customer loyalty that I would think it's very, very hard for another company to enter the market and actually start taking market share away from them. And as well, this company has already established a very interconnected digital and physical sales channels. So they're omnipresent in the sales channel. So any kind of innovation in that space would be very hard to conduct for a newcomer in the sector. In terms of regulation, I honestly doubt there will be any regulation to harm this company's operations. But in terms of performance and market, I do think that this is a very cyclical industry. I'm not a fan of cyclical industries, but this is because, as I said before, if there is a recession anytime soon or people don't want to spend that much and they want to save a bit more, they will instantly cut on home improvements. Is one of the first things they will cut. But my investment conclusion, first of all, I'm not a financial advisor and this is not financial advice, so please do your own due diligence. But I would say that it has a great moat with a strong competitive advantage. It has a higher return on capital employed, meaning that it creates value for the investor, but it does not have consistent cash flows that are not predictable and not resilient. So I believe that this is a good company and it will be a great investment, especially if revenue starts growing again. So thank you for watching. This has been the Cashflow Compounder. As always, join the free Patreon for extra content and there is a link in bio for free stock if you join Trade Republic or Trading 212.